Good morning, everybody. It's Monday, November 7th. I'm Jane Johnston with the Bar Hill Group at RE/MAX Camosun, and this is...
Hello. Hey, everybody. It's Andrew Plank with Royal LePage. So good to be here again.
How are you today?
Really, really good. Happy weekend. Happy week. Happy
Yes,
Halloween.
How was your week?
It was a good week. Yeah, out and about with clients and some adventures and catwalks and stuff like that.
Well, I'm glad we're going to be speaking about rates today because I heard an interesting thought today or over the week, and that is...
You can hear thoughts?
I can hear thoughts. Wow. And that is to buy the house and they call it dating the rate, but essentially in 2 years or so, refinance your mortgage to get the better rate. So if you like the house, buy the house, refinance your mortgage in a few years. What do you think about that?
Sorry, I'm not following you. So you're assuming that rates are down in 2 years?
Yeah.
Okay, so that's just making that assumption, and then you're buying the house now because you like the house now, and you may not see it in 2 years. So yeah. Okay. Got it.
Well, and also the market may, anyway, as we all know, the market can change on one day.
It can change in a day, and we can, we go from having lots of choice and options to having absolutely no options in the blink of an eye. And we've seen many markets in our time, haven't we, Jane?
Okay, so let's go over what's happening with the market this week.
Let's talk stats.
We
talk market in the last week. We're going to talk market then in the last month. And then we're going to bring in our guest speaker today, Tony Preziuso with RBC, and he's going to be talking about long-term financing. So as you know, most people get financing approval rates for 3 months at most. And that can be difficult if they're buying new construction that may not be built for a year or more. So Tony has some solutions for that.
Okay, awesome. Alrighty, so for month to date, so actually it was interesting because I was looking at the month to date for August and we're actually very similar. So.
All right, so as of November 7th, the right-hand icon there, we had 210 new listings in the last week. 106 properties went pending. What's really interesting is the price decreases now outweigh the pendings. We've got over half of the number of new listings. Not that these new listings are all having price decreases, but in terms of ratios, 124 properties decreased price. It's quite a lot.
And I think that's because a lot of people are looking to sell before Christmas. So they want to get their house down into a place where they're getting showings and then get the listing sold.
You and I both know that the market really starts to slow down end of November, December. There's not a lot happening. And so if you do have impetus or motivation to sell, you probably want to get it while there's still buyers out there.
Yeah, and what's interesting is the back on market. So when I see that, what I'm assuming is the seller and the realtor decided to possibly do some changes to the house to bring it more up to speed, maybe give it a good clean, stuff like that they can work on and then bring it back on market.
Yeah, we have an option when we have a property listed to take it off market. It's still an MLS listing, but it's hidden. And so that gives people time to, do some updates and stuff without actually canceling the contract and restarting. Or sometimes they've got personal reasons for just taking it off market. They're family in town for a week or there's an illness or something.
Yep. So solds are 193. So these are sales that happened earlier in the year, and they're going to be less than the October 31st date because just because people tend to close at the end or middle of the month.
Yeah. Okay. Right. 82 expired versus 43 expired. Again, that kind of a lot of people expire their contracts either the end of the month or the first week of the month, but it really depends on when their contracts are written. I tend to just expire my contracts based on if I list a property November 5th, I'll expire it, 2 or 3 months later, 6 months later, whatever we've agreed with the seller on the 5th or whatever. I don't generally try to round it, but some people do.
Here's a tip for you realtors. Don't expire your listings on the 25th to the 1st of December. December 25th to January 1st. Nobody's around. Okay.
Right.
Okay, so 83 net unconditional sales, that's compared to 653 for the month of November in 2021. And that is down. Well, I mean, if you look at it for the first week compared to 458, we're down from where we expect to be at the end of the month.
So in October, for the full month, we had 458 unconditional sales, which was actually up over the prior month, but down over the last year. Now we are the first week into November. If we've had a full week, we've only had 83 sales. If we forecast that out, that's still going to be a lot less than the November 21st, 653 sales that was full 4 weeks of November. So certainly looking like our sales are down, but they were. We'll see what we do. And, there's always time to rally here. We've only got the first weekend.
We're also down comparatively in new listings to 205. That's compared to 696 for the full months of 2021 in November. And listings last month, new listings were 980. So again, we're going to be less. And I expect when you look at the hump that we're going to be looking at in our graph, you'll see that this is actually quite normal.
Yeah, it is interesting that our active listings has gone down over month. We have 2,161 active listings currently, as opposed to 2,214 last month. So we actually have less inventory, or we've been building up on inventory. So it's interesting to see a little bit of a.
But again, way more than last year at 887. That was crazy.
Yeah. Oh, yeah.
Okay, total active listings. So this is looking at the past 24 months. Go ahead.
Sure. So, I mean, you can see here the graph at the beginning in October 2020, pretty steep decline. We always see a decline into November, December, as I was mentioning before. People are taking their properties off market and deciding to wait for the new year often. We tend to see active listings going up in the spring, but then if the buyers are equally buying, then those numbers are a little bit flatter. What we can see here from December 2021, inventory started to ramp up and continued to ramp up through the year, and we're just kind of reaching maybe a top here, September, October.
A peak.
Yeah.
So last year it was very flat compared to this year, where we peaked and then we kind of just sort of have one peak in terms of the listings. But I like this graph better because it shows the list to sales ratios. So, and you can see if you look halfway through the chart from December 2021, there's really two humps, and to me, we're getting back to regular market. What do you think?
Absolutely. We are definitely seeing, and we'll see that too if you have the slide for the, it shows the buyers versus sellers versus the balanced market versus, yeah. So that one really shows it, but we're really getting back. We've moved back quickly to a balanced market. We're moving towards buyer market territory, but that's also, I believe, we're probably going to actually balance out pretty quick here.
So the biggest difference between last year and this year, if you look from, I would say, March 2021 to December 2021, is the list to sale ratio was really quite close. Like the listings and the sales were close, and now we're seeing more of a gap. And so the gap just shows what Andrew is saying, is that we're more in a balanced market.
Yeah.
All right.
A market where the same number of listings that list sell speaks to the fact that people are buying anything that comes out, right? And a reasonable person doesn't just buy anything that's put in front of them. So when there's some selection, they're not going to be buying from the full range of properties, because out of 10 properties, 5 might be way overpriced. Another 2 or 3 may be just in really horrible condition. There's not going to be a full range that you're going to want to choose from. So that's why we talk about these ratios not being 1-to-1 and still being reasonable.
Okay, so in the sales to active listings ratio, this is looking at that ratio of listings to actual sales. You can see we moved from a seller's market where we had 120% ratio. So for every 10 properties that came out, 12 were selling. And now we're at a balanced market of 30%.
Yeah. And I remember, like, so this figure, this looks, if you look at this this graph, you're going to say, well, we're really, really low and for sales. But this ratio that we were seeing in the last couple of years was way high. And in most of my career, most of our career, Jane, we would have seen this graph wouldn't have gone above the sort of 50% number when we were sharing it with clients and showing the past sales to active listings ratio. And we would always show that the balanced market was somewhere in the 20 to 30% range. Below that becomes a buyer's market, and above that becomes a seller's market. And we've just been in such a strong seller's market that's become a new normal, but it's really only in the last couple of years that we've really seen this.
Right. Okay. So single family homes, this is interesting to me. We did peak in March, April of this year, but
average prices.
Yeah, average prices were not back to where we were 2 years ago. So a lot of people talk about the loss, but really we are holding our own here.
We've seen this in the past too, where the property values go up and up and up, and then people buy at a peak or some sort of plateau, and then the market drops somewhat, and it sits at the dropped bit for a bit, and then it comes up again. So over time, we do know, when you look at the history of markets and real estate, the property values go up over time, but there's always small times of dips, and this could be it could be a year or two, but it's never a decade.
Well, it looks over the past 4 months, we have a trend here of 1.2, and that's still up over where we were when we first started our podcast 2 years ago, where we were, possibly going to make it over 1 million. Now we're definitely over 1 million. We're holding.
Yeah, right. And we can see too that these average prices are not, we're not seeing we saw a steep dive from June to July, perhaps, that curve going down, but then it bolstered, and it's kind of been more of a straight line since June, July. Sorry, since July, August.
Yeah. Okay. Same thing with condos. So we were 2 years ago, we're around 500. We peaked almost at 700. Now we're tending to stay around the 600 mark. So we're still up 2 years, but not year over year.
Yeah.
Actually, year over year, we're still good.
Okay. There's been a bump more in condo values, a bumped more than house values in this most recent there's been a bit of a bump in values that I've been, not just values, but interest in condos has sort of resurged post-COVID.
Yeah. And so Andrew and I did talk about that before, how condos tended to lag behind homes. And then we had kind of the rubber band effect where then condos took off and people are now moving back into them. There's higher comfort level with being closer together.
Yeah.
Okay. Row townhomes. Go ahead.
Yeah. Again, this one's a little more granular. We talk about that. There's less townhomes that sell, so our averages skew around a little bit more. But if you squint your eyes and blur this out, you're going to see what this graph really looks like. Thank you, Jane, for the visual. And it is a curve up and down. It follows a similar curve to what we've seen from the other two.
Yeah. And I just want to say that all these are averages, and they're based on the whole greater Victoria area. So if you want more information about a particular area, ask Andrew or myself.
Yes.
All right.
Should we? Okay. So I'll let you do this one. Too many columns and numbers.
Okay. Looking at single family homes in Greater Victoria, our benchmark price for October 2022 was 1.193. And in September, it was 1.218. So we're slightly down year over year. And that is a decrease of 2% from last month and plus 10% from last year. So exactly what we were saying. In the core, those numbers are 1.341 for single family homes. That's compared to 1.364 last year for September of 2022. And it's up from 1.216 from October 2021. So that is 1.7% up from last month and up 10.2% from last year. West Shore is managing to catch up with a benchmark price of $1,059,000. That's compared to $1,067,000 for September 2022 and up from $930,000 from last year. by 13.8% and basically even for last month. And then in the peninsula, we're at 1.242. That's down from 1.286 from September 2022, but up from 1.144 in October 21. So we're up 3.4% over last month and up 8.6% last year. Do you want to do condos?
Nope.
Okay. We're at 5.
I think, well, I'm thinking we're 10:15 and we've got a guest waiting and we should probably move on. What do you think of sort of skipping through some of this stuff?
I'll just do a general thing.
Okay.
So the benchmark for October 22 was 596. That's up 2.2% from last month and up 15% from last year. Because I think people still need to know, like, there are a lot of people who are afraid who purchased last year. What we're showing is the numbers are steady for month over month and up 15%, 10 to 15%, depending on what you're buying. So the core is at 602. That's up 2.4% from last month and up 14.9% year over year.
I find sorry. I was just going to step in and just say, a lot of people are waiting to see what happens and this and that, but the news generally lags behind the market, and people watch the news and then hear all this fear and, scare about what the market's going to do and what's happening. And it's often behind the 8 ball in terms of what's actually happening. So it's really important that you do talk to your realtors and do look at the current stats, because when they do shift, as we said, they shift on pretty quickly, and we're not seeing that prices are dropping like people or some buyers are predicting based on what they're seeing or hearing from news.
Well, stats are dependent on what you're looking at. So if they're looking at February, then they have dropped. But if they're looking year over year, they're good. So, 554 for West Shore condo, that's up 2.1% from last month, but up 16.8% from last year. So really you got to take the long view when you're looking at condos.
Yeah. And prices certainly have dropped. I'm not denying that, but I'm saying that they're not currently dropping.
Yeah. We're looking steady. So for the peninsula, 633,000, which is interesting for condos to me, because previously, you didn't get the best quality of condo in Sydney. Now with the advent of newer
condos out there. Yeah. So the choices are much better. Yeah.
Yeah. And then we're up 13.3% year over year. And townhouses, I'll just do Greater Victoria, 802,000. That's up 2% from last month and up 11% from last year over year.
Thank you.
Okay. Do you want to introduce our guest?
Yeah, so I'd like to welcome Tony Preziuso from RBC. Hi, Tony.
Good morning.
Tony's a mortgage specialist. Tony, do you want to tell us a little bit about yourself?
I'd be happy to. Thank you for having me on your show. My name is Tony Preziuso. I'm a mortgage specialist with the Royal Bank. I've been with the Royal Bank for 18 years in this exact role. So love what I do, love helping people. I'm always on, similar to realtors, work days, nights, weekends. I eat what I kill, so I don't get paid unless the mortgage funds. So I think you're happy to know that. So it's important for us to work together, get the deal done, and get the client in their home.
Right. Yeah, absolutely. And you're talking today about a special product, but you offer all products that are available through RBC. And you also, I think, mentioned that you actually have. Well, I know that working with banks, oftentimes they have a certain set of products that are only available through that bank, but you actually have access to more products. Is that not right?
Oh, yeah. Well, I can do anything. Refinances, switch-ins from the competition, construction draw mortgages, long-term financing packages, which I'd like to talk to you today about. Mm-hmm. This package is really helpful and beneficial to clients. It really protects them to make sure they can follow through on this purchase. So I can go through the main points of how we protect the clients. Mm-hmm. And if we want, we can dive a little bit deeper into each subsection, if you like.
Sure thing. Now, so look, Jane and I work with a lot of buyers, on a regular house. They've gotten a pre-approval, and that approval might, the bank will say, I'm going to lend you money as long as the property is of certain value and so on and so forth. But if they look for too long, that approval has a set dead date, and it's usually three months. Is that not right?
Yeah, the standard rate commitment period for most lenders is 120 days, 4 months.
4 months. Okay, so 4 months of commitment, and of course that means if you commit to buying a place and then it closes within a few months after that, you're still good, right? You commit to the property, let's say 3 months in, and then close 3 months later. That you still got that rate lock, though, correct?
Yeah, the standard rate commitment period is 120 days. Anything after that, you have to reset the rates, and they're going to be applicable to whatever the rates are at that time.
Right.
So
Okay.
the big difference between this package and a regular rate commitment period is that we can hold rates for 2 years, 3 years. In Vancouver, we have some huge concrete steel buildings that we have rate holds for 4 years. So we can actually protect clients in a rising rate environment, which we're in, for up to 4 years. But typically it's around 2 or 3 year rate commitment period.
I have a question. So does that mean if the rate is 2.5% 2 years ago and they committed and it's closing next year, they're going to get 2.5%? Or is it based on a percentage of whatever the rate is? Like, so if it's prime, not a percentage, but if it's like prime minus 0.5, is it going to be prime minus 0.5 next year when it completes?
Yeah, so whatever the discount we can offer on the builder package, we're going to commit to that until it funds, if it's 2 years down the road, 3 years down the road. Now, the rates that we have for the builder program, they're not as heavily discounted as your typical rates if you were going to close within 120 days. Because we're holding the rates for so long, there's almost a premium added to them. But this is designed to be worst case scenario. So what happens in this particular package is 120 days before closing, we will reassess. If the rates are lower, the clients will get the lower street rate at that time.
So, okay, but just to be sure, so if they get prime minus 0.5 guaranteed or whatever, so that's not to say that they get 2.5 in 2 years. They get prime minus 0.5 in 2 years.
Well, again, we'll honor the discount. If the client chooses a variable and the discount's minus 0.50, whatever prime is at that time, we will honor that discount. Because not only does prime fluctuate, but the banks and lenders' discretion of what they can discount changes. If we say we're going to do minus 0.50 at the time of application, then fast forward 2 years, if the discount is shriveled in the marketplace to 0.10, then we still honor 0.50 off. So you still get the bigger discount.
You also, though, still approve the lend is still approved. So if you weren't to, let's say you were to get a discount of 0.1, and then 2 years from now you close and rates have actually gone up, so you're actually higher. You're paying higher than you originally had anticipated, but you're still going to approve that mortgage. Whereas somebody went at that time to go get that mortgage, they're not going to meet the stress test, for example.
Yeah. So what you bring to the table with that question is the more important piece of this package.
Yeah.
Everyone's rate conscious, and I get that. But more important than the rate is the actual firm approval that we do up front. Yeah. So we don't offer a pre-approval. We're not offering a conditional approval. We are offering a 100% firm approval at the time of application. So the vital importance of that is things change in life. Let's say one person is employed and they decide to be self-employed. Well, they might not qualify now that they've changed their career path. Yeah. Or banks change their lending policies. The government certainly changes their legislation. So they're protected. They're insulated from all that. No matter what happens in the world, if they get disabled, let's say they get hurt or injured and they can't work, doesn't matter. We're going to guarantee that we fund that mortgage because we got it approved today. That's the most important piece of this package, is the firm approval up front.
Yeah. Yeah. I think it sounds like a no-lose proposition. Obviously, some people want to ensure that they get the best rate and they want to, I guess, not put all their eggs in one basket. What your product does is gives people assurance and insurance against higher interest rates, against things going against them. It doesn't mean, as you said, that they're stuck with that, because you can always relook at it 3 months beforehand. And if their financial picture is better than it was before, the interest rates are better than they were at the time they got their firm approval, they can always adapt to those current rates and have better. But if things have gone worse, they're insulated from everything.
I have a question for you.
Yes,
Sorry.
please.
So we're talking about property valuation and appraisals being done up front too. How do you do that with new construction?
Great question. A lot of clients ask that because when they buy the home, it's just a hole in the ground. So what we do is we have a list of RBC approved appraisers. So they're vetted, they're qualified. They know the project because they have the floor plans, they have the disclosure statement, they have contact with the builder to talk about the quality of finishing. So we know if there's going to be laminate flooring or hardwood flooring. So they know the amenities, so they come up with a value today. So if someone is buying a home and it's a $700,000 condo, we're going to do the appraisal up front. And by the way, with this package, it's free. The client doesn't pay the $300, $500 appraisal fee. So we'll appraise it today and we're going to lock in that value. So 2 years from now, if the market corrects and that same unit is only $650,000, well, guess what? Banks and lenders usually lend on whichever's lower, the appraised value or the purchase agreement. So if the purchase agreement is higher than the appraised value, then the client has to make up that difference. So if someone waited and said, "Oh, my unit's only closing in 2 years, I'll get my financing done in 2 years," and that a unit appraises at 650 and not 700 what they paid for it, the client has to make up that difference above and beyond the down payment they planned on paying.
Right.
So they may not have those funds.
But with your product, they're insulated from that. So we can't insulate people from the market fluctuations, but we can insulate them from, like, if the value of the unit goes down, the value of the unit goes down. We can't protect them from that. They're still going to have a $700,000 mortgage on a $650,000 unit. But you pays your money, takes your chances. You've gambled by buying new construction long term, but you're insulated somewhat because you're still going to actually get the loan. You're not going to lose your deposit. You're going to be able to move forward. And as Jane and I said earlier, property values do fluctuate, and in the long term, you're probably still better off. And maybe you have a better rate, which makes that, even though it's worth $650,000 today, you may be paying equivalent mortgage to someone else because you have that lower rate.
But you're still paying so when I first heard of this program, I'm like, oh, okay, they're going to get 3.5% in 2 years, but it may not be that. It's going to be whatever the rate is, whatever the deal is relative to the rate at that time. I'm just wondering, is this a good move for RBC to do this? Because it sounds like if the market's going down, RBC is going to be in a precarious situation.
Well, I don't think you have to worry about the World Bank. We're the largest mortgage residential lender in Canada. And we've been in this space for almost 20 years. We've been doing this for 20 years. This long-term financing package, it's one of the best kept secrets. That's why I'm here as an advocate, just to say how important it is to protect yourself.
Tony and I went for coffee some months ago, and you told me about this product before, and it'd been on my radar, and then the penny dropped when we talked further about it, and I was like, oh, this is really, really good for that section of clientele that are looking for new construction. And Jane, I just want to check in with Tony on something you were saying, because we were talking about the prime, the discounted rates on the variable rate. But Tony, this product is also, I'm assuming, available for fixed rates.
Yeah, let me give you an example. Let me give you a good example of how important this project is. So about 2 years ago, a client came to me and said they were gonna buy a unit, and they wanted to know more about this package. And I explained everything as I did today. But sometimes it's hard to reinforce. Like there's no cost to this. It's a no-brainer. It's a win-win. There's nothing negative about it. Like if you choose not to use it at the end, then that's your prerogative. But it's designed to protect you in case things go awry, like with interest rates, for example. So one example that I have is 2 years ago, client wanted to buy a unit. He said, well, what's your long-term financing package? Well, the rates at the time for a 5-year fix were 1.95. That was the standard rate if someone was going to close in 120 days. But this was being held for 2 years. And I told them I had to explain that the rate for that length of time at that time period is 3.69%. And they balked. They said, that's ridiculous. Like rates today are 1.95. I'm like, I know this is worst case scenario. It's 3.69%. If rates are lower, 120 days prior to completion, we'll give you the lower rate. Well, fast forward to today when this unit is closing, he's thanking his lucky stars that he dealt with Tony and the rural bank, because we locked him in for 3.69. Whereas if he didn't have this package, his interest rate would be 5.5%. We literally saved him thousands of dollars in interest costs.
Right. And if interest rates had been lower, you could have switched to the lower.
If they went back to 1.95 or if they went back to 1.50, for sure, they get the lower rate.
And, you know, we also, there's something we always tell our clients, and mortgage brokers really tell their clients, like, you know, once you've got an approval for, you know, a rate approval, don't go buy a new car. Don't change jobs. Don't, you know, go shopping at IKEA and buy a bunch of furniture on your credit cards. Don't do that, because although you've been approved, that's a conditional approval truly until you've, you know, it's based on the picture you just gave us. But what you're saying, because of the longer time span, that picture is allowed to change somewhat. And you gave me an example even of one of the two people, a couple buying a home together, putting their money down on the deposit on something that closes in 2 or 3 years, and then maybe one passes or something happens. And
yeah, I can give you an example of it was actually a friend of mine who wanted to buy a condo unit on Yates Street as an investment property. And I said, well, okay, it's not closing for 1.5 years, but let's do the paperwork. Let's get it approved now. And he's like, no, I'm in a good spot. I'm in a good position. And I kind of reiterated, let's get this going. But he left it to the very end when it was close to complete. And to give you a bit of a background, he's a restaurateur. He owns like 7 restaurants. Mm-hmm. Well, guess what? Just as it was completing, COVID happened, and restaurants were closed.
Yep.
And Royal Bank took a step back and said, wait a minute, we gotta kind of tweak our policy. So for self-employed individuals who were impacted by COVID, we said, well, use a 2-year average of their income minus 25%, because we don't know if their income's ever coming back. So this was kind of a temporary policy that we put in place. And guess what? All of a sudden you don't qualify. Mm-hmm. Now what? But if he did this 1.5 years ago and we got it firmly approved, he would not have had to worry about that.
Right.
Mm-hmm. Yeah. And it's not a good scene when you don't qualify to purchase on the date of your purchase.
No. And here's the thing too, folks, you know, like if something changes in your picture, let's say the market's gone up substantially, but something changes in your picture and you're no longer approved to complete on this place. And the seller isn't going to necessarily allow you to sell the contract. It's called an assignment of sale, at least not without some profit. And oftentimes it can make more sense, especially if they're not going to allow it, to complete on the unit and then resell it and make the profit for it. So even if something has changed in your financial picture, this product allows you to actually complete on that product. And then, you know, let's say you actually have lost your job, you can't actually afford to pay your mortgage anymore, but they're gonna actually lend to you and complete on it, sell it, and actually put some money in your pocket, as opposed to not completing on it, losing your deposit, maybe getting sued further. Like there's a benefit to having this insurance, this policy. It's not an insurance policy, but it provides insurance against a lot of negative happenings.
Speaking of insurance, that's a good segue, because the last item, so we have the firm approval, which I think is the most important part. We have the valuation up front to lock in the appraised value of the home today. We have the long-term rate lock, but we also offer clients free mortgage insurance. So let's say there is a couple that have made an offer on a pre-sale, and one of them dies. The living person is going to inherit a free and clear home, because we're giving free life insurance, free critical illness insurance. So if someone gets critically ill, we'll lump sum $300,000 onto their mortgage. This is free insurance. They don't pay a single premium for the whole duration of the build. If it's taken 2 years to build, they're completely protected for 2 years. And at the end, when it funds, if they don't want the insurance anymore, they don't feel like they need it anymore, then they can just cancel it.
Yeah.
Free life insurance or free mortgage insurance?
It's free mortgage insurance. It's called creditor insurance, but it's life insurance. Like, we will pay off the mortgage.
Okay. So there is a charge to it once the mortgage funds.
Yep. Which they have the option to cancel if they don't want it. So in theory, they won't pay a single premium.
So that makes a lot of sense to be using that and taking advantage of that policy, because again, if something happens in the meantime before the close and there's a huge life situation change, as a, you know, for that couple, for example, if you didn't have that policy in place, you are now, let's say the partner that passed away was the breadwinner in the family. Now you're sitting there holding a contract you can't complete on. This actually allows you both to complete, but also the life insurance kicks in. You haven't even paid a penny, and you've got a condo to live in, or a house, or what have you. Jane, you're looking skeptical.
Well, I'm hearing two words. I'm hearing two phrases. One is mortgage insurance and one is life insurance. They're different.
Well, the life insurance is, as opposed to it being a lump sum that you can, you know, take and do whatever you want. This is designed to protect your biggest debt, which pays off your mortgage.
Right. Yeah, that's one of the things that mortgage insurance pays off your mortgage. Life insurance will give you the lump sum, which you could use for anything. But in this case, this is still an amazing product. That's an amazing option. Yeah.
I'm just a critical thinker. So
Yes,
Tony, how do people get in touch with you?
They can look me up on the World Wide Web and Google me. I have a little website there. My cell number is 250-661-5969. That's the easiest way. I'm always on, always on my phone, always beside me. Or they can email me at tony.preziuso@rbc.com.
Excellent.
Awesome. Thank you so much.
Excellent. Thanks
really
for coming in,
appreciate it.
Tony.
My pleasure.
Yeah.
Thanks for having me.
So if you guys want insurance on purchasing your new construction, I know I have some clients that are completing later next year who are a little, maybe you want to talk to Tony, and don't forget to reach out for him. Okay, Andrew, how do people get in touch with you?
You can reach me at 250-360-6106. Email me info@andrewplank.com. Check out the website, andrewplank.com, or follow me on Instagram or Facebook or any of the social media sites. And looking forward to connecting with you.
Okay, and I'm Jane Johnston with the Briar Hill Group at RE/MAX Camosun. You can reach me at 250-744-0775. My email is briarhillgroup@gmail.com. You can reach me on my website at briarhillgroup.com or at vancouverislandtime.com, and on Instagram at Realty Teacher, RE/MAX Victoria, and Vancouver Island Luxury Living. All right, so don't forget, everybody, we are on Mondays at 10 a.m. So we hope to see you there. Don't forget to subscribe. We'd like to see you here. And anytime that you have a question, please text or email Andrew or myself.
All right.
Sorry, Tony. All right. Thanks so much for coming.
Thanks, everybody. And nice to see you, Tony. Thanks so much.
Okay.
For coming in.
Take care.
Bye, everybody.